And finally comes implied volatility. This is a very complex topic for most people to understand. So options with very high IV are very expensive. Options with very low IV are very cheap. So let's not get into the details of what is this IV, where it comes from and all that. There is a number called IV which gives options a price. It comes from the market, and you can see the IV of an option in any standard option tool like Sensible or something else. I don't know what you use. So you can see that the IV of this is 32. The important point you have to understand here is that if IV goes down, you lose money, right? And if IV goes up, you will make money if you bought an option. So if you're an option buyer and if IV falls down, you lose money. So you have to know where the IV is, and if it's likely that IV will rise or fall, to know where your options profit and loss will be. So if you're an option buyer, ideally you should not buy options at a high IV, and if you are an option buyer, you should always target to buy options at a low IV, right? So we'll come to what is this IV and all that in a later video perhaps, but it is important to understand that IV usually is super high during times of uncertainty, or when market is in a downtrend, when there are a lot of gap down opens, etc. IV generally comes with bad news to the market, and when IV is high, markets will be expensive. Again, this thing also varies with strike and expiry. Now this is a good time to introduce another shorthand tool called Vega, which basically tells you how much your options P&L will change with 1 point change in IV, right? So we still haven't figured out where this IV comes from and all, but we need to understand that IV affects your buy trades, and we have to figure out ways to escape the impact of IV. So let's look at Vega. So as usual, we have our three candidates: 8700 call, 9200 call, 9600 call, ITM, ATM, OTM, three of them. And then we have our reference next month option. So the Vega of this one is 110, which is, okay, I don't know if it's low or high. Okay, this is 285, so this is low. And the Vega of this one is 140. So ITM has low Vega, ATM has high Vega, OTM has low Vega. So let's try to do some IV changes. So this says that if IV goes up by 1 point, so this IV is now 36.7, option P&L will fluctuate by 110 rupees. Is that true? Yep, this is true. You can see that option P&L is changing by 110 rupees. Let's confirm it with this one also. 285 is the Vega. 285 precisely is the change in option price or P&L. This says Vega is 140, so this should become 144. Yeah, roughly 146, that's precise. So ITM low Vega, you don't have to worry about IV much. ATM 2.5 times as much. OTM, yep, 1 point change in IV is quite a bit. I mean, not so much, 134, but not as much as ATM. But here's the interesting part. Look at this, 813 rupees in Vega. What it means is that if IV goes up 1 point, your P&L changes by 800 points. To put things in perspective, this is as big as 20 point change in Nifty on an ATM. Let's see that, right? So if I change this to 9199, or let's just do round numbers, right? 9200, you get 800 rupees, right? So that's 20 points. Whereas if IV goes up 1 point, you make as much. So this invisible little thing called IV is actually affecting your portfolio by a full 20 point move in Nifty, right? And so this makes it very important that you pay attention to IV, especially when it comes to far away options, because the Vega or the effect of IV on the P&L, which is this number, is very high for far away options. So if you are trading far away options, you have to be very careful about IV. So if you think that market is going to become less certain, or market is going to become less bad or less negative, or if it's going to go up, etc., you have to assume that IV is going to decrease. So if you are thinking I am bullish on the market, or uncertainty is going to reduce, or events are going to get over soon, etc., and if you're buying an option, whatever you make in movement of the underlying, you might just lose in Vega, unless of course you catch huge moves. But Vega is a significant consideration. So let's say IV dropped by 5 points and Nifty went up by 100 points. You make 4,000 rupees on Nifty movement of 100 points, but let's say Vega dropped 5 points, you're pretty much making nothing. IV dropped 5 points, you're pretty much making nothing. So ITM near month expiry, no Vega. ATM somewhat Vega. OTM low Vega. Next month option high Vega. So if you are trading options, pay attention to this number, especially in the far month.
So the stock price affects option, strike price affects option, expiry affects option, passage of time affects option, IV affects option. All these things affect option. They affect these options in different ways depending on the strike and expiry. This could be confusing. I would highly encourage you to play around with a tool like this, because it kind of helps you experiment with which option should be your choice of playing out your move. Because if you're not very clear on which option affects you how in terms of underlying move, in terms of IV move, in terms of time value decay, etc., you might end up choosing the wrong option for the wrong move, and that is going to be very detrimental. Alright, so let's again go back to ground and look at some simpler concepts. So what is the good thing about call options? They are great to play big moves. What is the bad thing about call option? It is very low capital requirement. Wait a second. How is that a bad thing? That is a bad thing because this very low capital requirement is very attractive and makes it perfect gambling instruments, right? Now the problem is most of these options expire worthless. So again, if you look at this option, right, like let's say this 9700 April option, what are the odds that Nifty is going to cross 9700 in the next 4 days? Very low, right? So if I look at expiry day 9700, it's not going to cross 9700 in 4 days in all probability, because it's a 6% move we are looking at. That is unlikely. But then for 11 rupees, that is 11 into 12 rupees, that is 12 into 75, it's a very cheap option, right? How much is that? It's around 900 rupees in premium. It is very attractive to gamble with this thing, and therefore this low capital requirement makes it very dangerous, and it will most probably expire worthless. Most retail investors go bankrupt by buying options. So therefore it's a great idea to stay away from these lottery ticket options. Last section on this one, it's been a slightly lengthy one. The last section is do's and don'ts. So always use a payoff stimulator to know what to expect. Compare different scenarios. See, this is important, right? You have to always compare different scenarios whenever you're doing any decision in life. You can't decide ki chalo, let me go buy 9,000 call of April. That's not how it works. You have to ask yourself, what is the move which I'm going to play? Is it going to be a big move, bad move? You have to compare 9,200 call of April with 9,200 call of May and see which one is better, right? I mean, this is how you do things. So see, 9,200, you saw all the things. 9,200 May, you saw all the things. Or you can compare it with 8,700 of April or May, whatever. But you have to do this comparative analysis to figure out what you are doing and what to expect in terms of P&L. You have to know your profit and loss at various levels and the break even, because if you are doing that without knowing it, then it's absolute suicide. So for example, if you are looking to buy the 9,200 April option, you know that the break even is at 9,328. So you have to ask yourself the question, where is this 9328? Let's look at that, right? 9328 is 2% away. Is there going to be a 2% move in the next 4 days for Nifty? If the answer to your question is going to be a no, sorry, this is not expiry, so this is break even, right? If the answer to your question that Nifty is not, is Nifty going to move up, let's say around 200 points in the next 4 days, is going to be no. You have no business buying this option. So this becomes a no. So this is why it's important to know your P&L and break even. Again, most options expire worthless. Do not buy options with too much cash. OTM options are lotteries, right? And they are very cheap, which means they are deadly money losing combination. Option value decreases exponentially towards expiry, like we discussed before. Therefore, you have to be very careful when you are having options near the expiry. Option values decreases over weekend, so you have to be careful when you are holding them. and avoid buying options at very high implied volatility. Why? Because if implied volatility comes down, your options are going to lose value and you are going to make losses. And higher the implied volatility, higher the option price. So if you buy at high implied volatility, you're paying too high a price to buy an option. So events such as results are a bad time to buy options to try to get lucky. This is because during results, during events, etc., options are going to be priced highly at a very high implied volatility. So to recover so much more premium is going to be fairly difficult. And the last point is, don't buy call options during market crashes aiming at reversal. So even if the reversal happens, see, first of all, nobody can time the bottom. So even if you try to time the bottom by buying market at a particular dip, if that is not the dip, you are going to definitely lose money on the call option. But in case it reverses, right, even if it reverses, when market crashes, the option price will go up because of high IV, and this high IV is going to be very difficult to recover. So let me just take one example of that to illustrate that point. Let's take a stock which is doing badly. So let's look at some stock which has tanked quite a bit. Bajaj Finance is trading at 1976, and the at the money option of 2000 is the closest strike, is trading at 83 rupees. This is a very high IV. So you can see that IV is at 91. We saw Nifty IV at 32. This is very high, which means that option price is going to be so much more expensive. You can see that here also, because this option is almost 2 times the Nifty ATM option. This is 20,000 rupees. So if you have to recover money on this option before expiry, how much of a percentage move do you need? You need a percentage move of 5.2% in 4 days. Now this is going to be difficult. So even if you're going to play for the reversal, even if it jumps up 3% or something in the next few days, you're not going to make much money of it. Even if you're trying to do this as a 1-day trade, and if its stock goes up around 1%, the risk is once the stock starts going up, IV will crash and you lose money on IV. From 91, if it goes to 85 because of reduced uncertainty, you'll still lose money, right? So high IV options can lose money even if your view is right. So let's say the stock jumped up around 1.5%, but if IV crashes to, let's say, 78, you lost 1450. So this is extremely important that you don't buy high IV options even if you're very sure that there's going to be a reversal from a bearish trend.